We are disrupting the shareholder engagement business.
Communication and tech revolution we're living through.
Founders going offshore. Look, that's a big issue. Good evening, everyone, and welcome to our panel discussion event this evening. Australia is a platform for tech innovation. Our CEO panelists, who I will introduce shortly, make up a diverse group of companies focused on the areas of medtech, online classifieds, investor relations, and consumer insights. Everyone has their own view as to whether Australia is making the transition to newer, smarter industries quick enough, but it would be interesting to get insights tonight from these companies who are really at the coalface in terms of creating new products, new services, and most importantly, upskilling employees who will ultimately lead the next wave of innovation in this country. My name's Niv Dagan. I'm Executive Director and co-founder of Peak Asset Management.
I'm Paul Chan, the founder and CEO of Pureprofile.
Greg Taylor from Blue Ocean Equities.
Initially, our phase one of our development was set about by linking the patient with a pharmacy, and one of the things that people really don't have good connection with is understanding how to manage their medication, getting visibility of the medication that they're taking, where their scripts are, and ultimately being able to take their medication safely, effectively and on time.
We do quality movement analysis. So think of us like a Fitbit, but we provide quality data. And we don't just sit on the wrist, we'll go anywhere on the body. We'll go on Wayne Rooney's knees at Manchester United and analyse how he's running.
Market Tide is the leader in digital stakeholder engagement. What that means is that we connect stakeholders, whether they are shareholders, employees or members of organisations, with the organisation. So we're doing this through a digital channel, through an app.
It's probably the easiest way to describe our business is we're aiming to be like the car sales of Latin America.
We look for investment opportunities where people redefine their competitive environment more often than not in the technology field.
To introduce something and solve a big problem. And the big problem that we saw at the time was that the majority of data and insights collected at a quantitative research level was done by calling you when you were having dinner.
So we're making the process a lot more efficient, we're saving money, and we're focused on the environmental benefits as well as not using as much paper.
So car classifieds online in 6 countries in Latin America. We have a target population that's 10 times the size of Australia. It's around a 220 million population. And as a result, there's a pool of around $1.8 billion of advertising revenue in the autos vertical every year.
70% of all quant research is done online, and we're a major or the biggest player in Australia.
I'm curious to hear from the panel what you see the role of government being in terms of directing more investment towards earlier stage companies in Australia.
The new focus on innovation, I think it's absolutely timely and important for the space we're all in.
I think anything that the government can do to make the roadmap easier for small companies to identify where the best funding opportunities are is a major step forward.
Even as a listed company, but a smaller listed company, there is still a lot of red tape that we get bogged down in compliance.
An interesting topic right now that we're seeing is the difference between reverse takeovers and IPOs. And we're seeing a lot of mining companies and oil and gas companies turning to become healthcare companies and IT companies. What are your views on reverse takeovers? What are the benefits from a reverse takeover from your perspective, and why did you choose to go through an IPO, direct to the market, relative to an RTO?
We considered both actually, and we had a couple of shells that were willing to kind of negotiate with us to do a reverse takeover. Ultimately, we did a front door listing, just a regular IPO. The reason being is we just couldn't see any real benefit from a timing point of view, which was our key kind of consideration. I think either the ASX or ASIC now requires you to sort of redo a prospectus-like document, which would have taken just as long as doing the front door option. And I think you have, if you've done a reverse takeover, you have a shareholder base that has been involved in another business, which that might be completely different to what your business is, and if they don't like it or if they're not familiar with it, they can sell their shares straight upon. Once you list, they can sell their shares on market if they don't like what it is. So there's always that sort of tail risk. So from our point of view, we just chose the front door option, and just did it as quickly as we could, and I think it was a good choice.
We were the opposite. So we ended up going through an RTO process, and I think it comes down to a case-by-case situation, because I don't think there's any less work in an RTO, and having been involved in a couple of IPOs on the other side, it was definitely more onerous from a number of perspectives. You certainly have to do a share sale agreement, reverse due diligence, and a whole other layers of complexity that comes into it, notwithstanding the ASIC oversight and real attention that comes. And there are a lot of RTOs that have to issue supplementary prospectuses, and it can become very, very onerous. In our case, it was much cleaner. We had a number of seed investors who also happened to be significant investors in the shell that we were involved with, so it was a very tight register that had been cleaned up over time. It allowed us, in our case, to announce some certain milestones that would have got lost in a disclosure document of a prospectus, I think, and show the progress of the business through that capital raise process. Through the announcement that the announcements that the listed shell could make, and I think it's worked out well for us. Once you move on past the gate of having those issues around shares that were worth 1 cent now worth 3 or 5 or whatever the price may be, you've got clear air again. And you look at companies like Vocus or Yowie or those guys. No one's talking about them being reverse takeovers anymore.
So when we listed, we did have, like what you've said about people exiting that were previously in mining that didn't want to be in tech. That does pull the stock down initially, but I don't think going forward it does define you. I think that it comes down to the product and to the business and to the management and the leadership. And I do think it does, creates a good buying opportunity for others to come in. So it's not necessarily a negative, but I think that you've got to look, as has been said, as the right structure for the company at the time. But going forward and 12 months on, it certainly doesn't put you in any particular category. You've got to look at the organisation and the leadership and the structure.
How did you arrive at that decision that it was the right time to list, and what have been your sort of experiences, and would you do it differently if you had your time again?
We did consider listing on the Nasdaq as a matter of fact, given the time zone and the markets that we're in, but we just would not have got the attention from small cap investors. I think in Australia, you've got a long history of smaller mining companies that are pre-revenue exploration, higher risk sort of companies where people are willing to back the management team.
Private or family money as an alternative for early stage companies to approach. And I think with a lot of investors looking away from, or trying to look at solutions away from the top 20, top 30 stocks, there is a pool of capital that's looking for opportunities that will go from small to large over a period of time.
It hasn't been the easiest path, no doubt. I mean, it's very visible what you do as being a listed company, but I do think that you have to look at it from a case-by-case basis. And in hindsight, although we have had, there's been ups and downs and we've had delays in development and all those sorts of things, I think that we are definitely where we are today because we did list early.
I'm definitely positive about the ASX experience. We're a lot larger now. We'll probably do 30 million in revenues this year, and we're making money. But I don't think that necessarily needs to be the only drivers.
I see it more as the foundational building blocks before you list, because they're concrete and that's what you build a good business on. So if you've got those foundational blocks right and you build barriers for competitors coming into your space, then I don't think it's so much about revenue, but it's about being able to have that foundation right before you list.
Defining what is that point of difference of your business, that part that makes it sustainable.
So the main, key difference that we have is we do things that are, one, very, very hard. So we're not a services business, we do build technology. And two, we have a lot of know-how and experience that's come together in an extremely now fast-growing market in the programmatic advertising space. Because
we've attacked this problem very differently to other people, where they look at it from a product-specific standpoint, or they look at it from a pharmacy chain-specific standpoint, or a manufacturer, we attack it from the patient. What's going to make life easier for the patient? And to do that, we need to build really, really smart technology. We're
good at measuring people's movement accurately, and why that's relevant and why we needed to be good at that. If you look at 3 quick examples. If you look, when Apple went to bring out the iWatch, it had 3 health metrics in it. The FDA said, take them out. You can't release that watch with those health metrics. They haven't been proven valid. If you look at Fitbit's recent issue in California, they've got inaccurate heart rate data, and so there's a class action on them about that. A third one would be 23andMe, which is a genome group, and the FDA absolutely really hurt that business by asking them to take a pretty important part of their product off the market.
What could we be doing as an industry to try and encourage the growth of homegrown talent?
I think going back to the government and technology and retaining talent in terms of making the visa more applicable, investing in technology and education is very, very important.
I also do commend organisations such as Seek.com. I know last year they did run a program for girls aged between, I think it was about 12 and 15 years old, to have a school holiday program, and they were mentored through that school program. So I think things like that are very important to encourage girls, but I think it has to be a curriculum issue again, going back to the grassroots.